Warren Buffett is currently holding nearly $400 billion in pure cash. That is roughly 60% of his total investable portfolio. He has never held this much cash before in history. The legendary investor is quietly sending a massive warning to everyone. He believes the stock market is approaching a dangerous turning point. Most retail investors are buying equities at all-time high prices. But Buffett is moving to the sidelines faster than ever. Here is what his moves reveal about the next 6 months. The $397 billion warning. The stock market is currently trading at record-high valuation levels. Wall Street analysts continue telling people to buy every single dip. Yet Warren Buffett is doing the exact opposite right now. Berkshire Hathaway has been a net seller of stocks. They sold more equities than they bought for consecutive quarters. What most people do not know is how Buffett measures value. He uses a famous metric called the Buffett indicator. This tool compares total stock market value against national gross domestic product. When the ratio goes over 100%, stocks are expensive. Right now, the Buffett indicator sits near 219%. That level is over 2 standard deviations above its historical trend. In simple terms, stocks are severely overvalued relative to economic output. Buffett once called this ratio the best single valuation measure available. When it reaches extreme levels, stock market returns usually vanish. That is why Berkshire accumulated nearly $400 billion in cash. They now hold more short-term treasury bills than the Federal Reserve. He is earning over 4% interest on those government bills. That generates billions of dollars in passive income without taking equity risk. He is waiting patiently for prices to fall significantly lower. But before you skip to the end, look at his sells. The major stocks Buffett is dumping fast. You might wonder which stocks Buffett is actually selling off today. The answer might shock a lot of mainstream technology investors. First, Berkshire completely eliminated its position in Amazon stock. They cut the holding down before selling every last share. Why did he exit Amazon after holding it for years? Valuations on tech giants became too stretched for value investors. Furthermore, capital spending on artificial intelligence data centers exploded recently. That huge spending reduces short-term free cash flow significantly. Second, Buffett cut his massive stake in Apple Inc. Apple was once almost half of Berkshire's entire stock portfolio. He trimmed millions of shares to lock in historic capital gains. He mentioned higher future corporate tax rates as a key reason. Third, he steadily reduced his stake in Bank of America. He sold billions of dollars worth of financial stock shares. Banking stocks face tightening margins and potential credit loss pressures. He also slashed his holdings in Chevron by over 30%. The message behind these sales is remarkably clear and direct. Buffett is stripping risk out of his portfolio right now. He is reducing exposure to high multiple technology and cyclical banks. The surprising part comes next when you look at his buys. The rare stocks Buffett is buying today. Even while holding massive cash, Buffett is not sitting completely idle. He's making very selective, highly targeted stock purchases today. His biggest tech purchase recently has been Alphabet, the parent of Google. Berkshire increased its stake in Alphabet Class A shares dramatically. They also opened a brand new position in Alphabet Class C shares. Why does Buffett prefer Alphabet over other big tech giants today? Alphabet trades at a lower valuation multiple than its primary peers. It possesses a massive cash flow moat through search and YouTube. Its dominant market position provides strong downside protection during recessions. Buffett also built a brand new position in Delta Airlines. He bought nearly 40 million shares of the airline carrier. Travel demand remains steady, and airline stock valuations look quite cheap. In addition, he continued buying homebuilder stock Lennar Corporation. America faces a structural housing shortage that will last for years. Home builders maintain strong pricing power and solid cash flow balances today. He also expanded positions in media company New York Times. Subscription revenue model businesses provide predictable, recurring income streams for shareholders. If you are finding this breakdown helpful, please hit subscribe. Joining our community keeps you updated on critical financial shifts daily. Notice the common theme across all of these stock purchases. He buys companies with low valuations and reliable revenues. What most people do not know is how this shapes 6 months. What the next 6 months look like for stocks. When we analyze Buffett's actions, a clear 6-month outlook emerges. He is preparing for increased market volatility and lower returns. The stock market has enjoyed strong gains over recent years. Index gains were driven largely by a few giant stocks, but corporate profit growth is starting to slow down overall. Buffett noted that markets currently display strong gambling tendencies among investors. Speculation in high-risk assets has reached very elevated levels. Retail traders are buying expensive stocks out of fear of missing out. History shows that extreme market valuations always revert to average levels. That process can happen through a sharp stock market crash, or it happens through years of stagnant, sideways market returns. Over the next 6 months, interest rates may stay elevated. That makes high-risk growth stocks far less attractive to institutions. Meanwhile, risk-free treasury yields offer a safe alternative for cash. Buffett is not trying to predict the exact top of the market. He simply positions his capital so he cannot lose money. He protects downside risk before thinking about upside gains every time. Before you make your next trade, learn his personal playbook, the beginner playbook. To trade like Buffett. Now, you do not need $400 billion to invest like Buffett. You just need to follow his core investment principles today. First, build a solid cash reserve inside your investment portfolio. Earning guaranteed yield on cash is better than losing money. Cash gives you total power when stock market panic hits later. Second, stop chasing overhyped technology stocks at record high prices. Focus on cash flow, earnings growth, and strong competitive moats. Look for stocks trading at a comfortable margin of safety. Third, consider broad index funds like the S&P 500 index. Buffett famously instructs that most people should buy index funds regularly. Dollar cost averaging protects you from buying at the exact top. Fourth, control your emotions when stock market volatility picks up momentum. The stock market transfers money from the impatient to the patient. Buffett's edge is not secret insider information or complex algorithms. His true advantage is discipline while everyone else panics or chases gains. Keep your portfolio balanced and prepare for real buying opportunities ahead. Look out for our next video posted daily.